Hi, everyone. This is Jason Barrick of Wall Street for Main Street and managing editor of the News Doctors and independent financial journalist Eric Dubin. Welcome back to another Welcome to Dystopia podcast. This is episode number 14. Happy New Year, Eric.
Happy New Year to you and all of our listeners.
Now, Eric, I want to talk about, review of 2015. Mo Dawood and I spent weeks writing a long report with a review of 2015, a preview of 2016, and some investing and trading ideas in there. But what were your ideas on what we saw in 2015?
Oh, man, it was a crazy year. I guess one of the things that is most interesting is that the powers that be, the Federal Reserve, the folks in the Treasury Department, and all of their compatriots in all the various countries of the Western world in particular, and China, for good measure as well, should be thrown into that picture, have been able to juggle all of the various plates that they've got moving on. I mean, the shadow banking system is creaking and about to just completely roll over with this commodities crash that we've got going. And oil slicing through 30 now. I reflect on what I went through like in my early 20s and early teens when I was going through undergrad in economics, and what the state of the art, so to speak, of the profession was back then, and in reflection of, where the markets were. I mean, it wasn't all that long ago, just a couple of decades ago. I'm 46, and I remember back in 1989 taking the banking credit class under fundamental economic coursework, and the degree to which they would speak about the shadow banking system was like trivial. I mean, here they are teaching the future people in Wall Street and policy and so forth in the economic textbooks of the U.S. university system, and there's virtually no discussion of shadow banking. Can you imagine that? Here we are now. Here we are now. The real gist of why we have such amazing problems in our financial system now is the degree to which the growth of the financial shadow banking system and leveraged credit pyramid, this inverse, the Exeter pyramid, is grown to heights that have never been seen before. And the leverage grows and grows. Each time we have a crash, we get a bigger bubble to reflate it. And, here we are. 2000, we crash. 2016, we crash again after the real estate bubble replaced the technology bubble. And, who knows what they're going to come up with next. We'll discuss that later. But we're in the process of the shadow banking system basically having the underlying credit for assets evaporate. This is money, so to speak. It's not money, but it's money heaven. And money is basically fading, and that's a deflationary crash that is basically taking down the world economy, and it's happening.
Well, you brought up the shadow banking system, and they obviously don't teach that in most MBA programs, especially definitely not in undergrad, but in MBA programs and things, I doubt they teach that too.
They teach it a little bit, but the professors, frankly, were taught in an era when I was taught, and they don't understand it because they've never been financial practitioners in trading context. They're all academics. And understanding the degree to which this financial monstrosity has grown is something they just don't understand.
Yeah, there was no credit default swaps, and, mortgage-backed securities were maybe a really tiny portion of the market. I saw the Big Short last weekend. So mortgage-backed securities, I think, did start in the 70s or 80s, but they were very tiny. They didn't start to rapidly explode for a while after they were first created. Then they started to rapidly explode with the Community Reinvestment Act. But there's so many, commonsensical things that business schools don't teach. I mean, personal finance people should learn how to balance a checkbook, but they don't teach you, where money comes from. They don't teach you to question the government's definition of money. So they don't teach you about, fractional reserve banking or debt-based fiat currencies or all the bad things central banks have done, create asset bubbles.
I'd quibble a little bit on that because they do teach the fractional reserve banking, and that's a great example because, that's the cornerstone of the education that they were shoveling down my throat when I was an undergrad. Oh. But the thing is, they don't actually contextualize it. They don't really give the understanding as to where our credit system has grown. That's the problem. People don't understand what really is the nature of our credit system.
Yeah, and 2015 for me was a year of, increasing volatility. In the other prior years, really since the reflation started in 2009, the FASB, Federal Accounting Standards Board rules were changed for banks for their for how they mark their assets. A lot of the main asset markets, which are, stocks, bonds, real estate, those asset markets pretty much went straight up with very minimal corrections, the broad market speaking. But, we started to see more volatility come up in 2015. But the real main culprits is that the emerging markets and the base metals and oil, those things started to rapidly fall. And the thing is, all the people in the U.S., the mainstream people in the U.S., the pundits on CNBC and Bloomberg, the Keynesian economists at the Federal Reserve, the Keynesian economists on Wall Street, they're talking about how the U.S. is still creating all these jobs, right? And the U.S. is recovering. Oh, it's a slow recovery, blah, blah, blah. Well, how can the U.S. be recovering so well when the global economy is so interconnected and we see evidence, basically you and me could name tons of different evidence. People can go to Zero Hedge and look at, 5 articles over the last couple of weeks about the global economy, whether it's China or Brazil or some of these other countries, how drastically things are slowing down or falling apart. And, eventually this is going to catch up with the U.S. Obviously flight capital has come into the U.S. Since really, for many years now it's come in, especially after the 2008 crash, but it's been coming in even faster now lately from the emerging markets and other countries into the asset markets. But, that's kind of exactly what happened to the U.S. prior to October 1929. The U.S. economy was booming back then. The rest of the world was already in a depression. A lot of money came into asset markets back then that helped fuel the stock market bubble even further, besides, the margin debt and the property bubble back then and things like that. So I'm starting to see reminiscences then. We had the 2008 crash, but we're looking like we're setting up for another one because people are desperate and they brought the money from other markets back into the U.S. one. And, the real economies, Eric, in base metals, in oil, in the emerging markets, these things look like they're about to blow up. And, these things, to me, in terms of sheer numbers, I think they're a lot larger than subprime housing.
Oh, yeah. You're talking over $10 trillion of shadow banking system debt in aggregate when you add up third world debt and the oil energy sector debt and just general sovereign debt that's impaired that isn't necessarily as bad as, say, Brazil. There are countries that are not as bad off as Brazil, but all told, we're talking about a huge pile of debt. It's at least 6 to 7 trillion, and it's probably over 10.
Yeah, and it looks like, the banks don't want anyone to default on it, so they're coming up and we see this in the oil market too. So the banks or whoever is the creditors are coming up with clever ways to try to buy just a little bit more time, hoping for some type of rebound. When I look at the shale oil producers, to give our listeners an example, Whiting Petroleum, which took on billions of dollars in debt to do an acquisition, basically right at the top of the oil market there as the shale boom was about to bust. They bought Kodiak Oil and Gas with massive amounts of debt. And so, now they're in a situation where they have all this debt. And, when the chief financial officer of the company was running, the numbers for the acquisition and, can we afford it? What cash flow will it bring us? How quickly can we pay off the debt with the acquisition and things like that? The numbers worked at a higher oil price, but now they're stuck with the debt and the oil price is much lower. And then now you have a situation where with a lot of these oil companies, Eric, they're telling the investors, and Goldman Sachs had an oil conference, I think, with the shale oil producers this past weekend, saying where the oil producers there were basically saying, we're cash flow, we've cut costs in the shale oil production in the Bakken and the Eagle Ford. We've cut costs down to $50 or cash flow positive at $50. But oil's not at $50. So you have a situation here where, they won't be honest. They won't talk about how bad things really are with their cash flow and their wells and things. And because they have so much debt, they haven't cut back the oil production like they should. They're drilling, they're still producing oil even at a loss just to pay off any little debt that they can to buy themselves, another couple weeks, another month, another 2 months, another quarter or two in the economy in 2016. To delay bankruptcy. So, it's just a race, I guess.
Yeah.
It's a race where, maybe their $5 billion, Whiting Petroleum, same example. You know, they're billions of dollars. I think they're over $3 billion debt in the hole. So another $100 million in debt, you know, when they could go bankrupt soon, that's not a lot of money. So maybe they're getting like a lifeline. They were talking about how they were going to max out basically what's left of their revolving credit facility. So they're taking on even more debt to delay bankruptcy. So it's just crazy, all the games and gimmicks. And the banks, I guess, because they don't want to write off the loans, are all too eager to delay the write-off of the loans and the bankruptcies as long as possible.
Yeah, and, you know, when we began November last year, we were pretty close to $50 West Texas Intermediate. Now we, you know, just sliced through 30 a couple days ago, and we're a little bit above that right now, about $31. But that just goes to show you the kind of acceleration, realization that people around the world recognized in the latter part of last year when it came to this deceleration in the economy. And then if we remind our listeners, you know, back in August, we had that really strange dynamic going on with the Fed basically dumping in a huge amount of treasury collateral into the global system, with targeting primarily European financial institutions needing, you know, backup for collateral on their derivatives positions. And that really was the first indication that you could see in the market from a price action, you know, just watching various sectors and things moving around. And we recorded a shadow. Sorry, I a little brain fart there. I mentioned Shadow of Truth, thinking of Dave Kranzler, because he's the one who spotlighted this particular move. But we did a Welcome to Dystopia episode. I think it was somewhere around number 8, give or take. Memory fails. But, you know, back then it was very clear that there was something seriously weird going on in the financial markets, and the powers that be were trying to address it. And we're seeing that acceleration, frankly, from that point forward. That's when you saw a stepped up crash move down in the Baltic Dry Index. Chinese containerized shipping has been crashing ever since. The whole machinations and craziness that was going on with respect to currencies and the Chinese stock market also hit around that time. And it's really a continuation of this earthquake that's going on in the shadow banking system. And the sad thing about it is that the policymakers, though some of them I think do understand what's going on, people like former Federal Reserve Governor in Dallas, Fisher, certainly gets it. He's more of an Austrian. He's no longer in a voting position, but, you know, there are elements that you can look to within the Fed and see that they know what's going on, and that just gives you more insight as to the scrambling that they do when it comes to their formulation of policy. Back in January, you and I did a recording last year talking about the upcoming year and the probability of them doing a token interest rate hike just because they would be forced to maintain their credibility. And that's essentially what happened. And now people are recognizing that the economy worldwide is rolling over and it's going to hit the United States, and the Federal Reserve is stuck. And it's the scenario that we mapped out back in January, and it's unfolding in front of us.
Yeah, for 2016, I think what's gonna increase in 2016 is volatility. I actually spoke with a hedge fund manager because I've been sending out my report to people in my contacts list, like famous people like Jim Rickards and things like that, to try to get some feedback. And a hedge fund manager read my report really quickly. He made a lot of money, this guy particularly, his firm did in 2008, shorting the subprime housing bubble and things like that. And he told me basically that he's short everything to the hilt except for gold stocks right now. So it'll be he's an Austrian school hedge fund leaning. So it'll be interesting to see how 2016 holds. But I think that's valid. I mean, even though the oil price is low, you know, look at all the store closures. Walmart's closing mass amounts of stores. So this the lower oil price was supposed to give the consumer more money to put in their pocket to spend and things like that, right? And that has not happened.
Well, I mean, there is more money in consumers' pockets because they're spending less on oil. I mean, recognizing that is indeed a fact. The problem with it is that that's really not a full analysis of all the various moving parts going on. People have less money overall because the economy is rolling over, so they're just paying down debt or paying expenses or what have you, and there's been no boost to consumer spending for the most part because of that so-called tax cut to the economy, as all of the policy wonks like to describe it as. And the real problem is actually more systemic, because oil and commodities in general are so integral to the shadow banking system, because they end up serving as the collateral that the firms that are taking out loans from the shadow banking system, and when the underlying collateral erodes, the entire financial system in turn erodes, and that's what we're seeing.
Yeah, I think the oil market, I wrote in our report that just came out, our listeners should go to wallstreetformainstreet.com website and sign up for our email list. If they don't have the report, if they want it, it's free. It's free. Modu Wood and I spent weeks writing it. I think there's a lot of value in there for people. If you've read it, give us feedback either underneath this video or send us an email if you liked it. Or if you're interested, you can do it another way. But I think the oil price is a major choke point, Eric. People are talking. I hear in the mainstream that oil is going to go down to 10. It may temporarily go to 20 or 15 or 10, but that's a price where really none of the people on the supply side, the producers of oil, can survive. So we're looking at huge, absolutely huge supply problems in the future setting up, and we've already seen, I think, $380 billion with a B in CapEx cuts for future oil supply that was planned to replace reserves, find new oil. That's a lot. That's out of like the $700 billion or $800 billion that was being spent for CapEx to find and replace reserves and things like that. So there's going to be long-term consequences to this. But, if the Fed, you talked about the Fed's credibility, if the Fed attempts to raise, rates anymore, maybe they do another token interest rate increase or not. I don't know. Nothing's guaranteed anymore. There's so much manipulation and stupidity from the Keynesian central planners. But if they do try any more rate hikes, I think something's going to break. Something in the asset markets is going to fully break, with collateral, or in the shadow banking system, or in the over-the-counter derivatives market. Something in the real economy is going to break. Maybe with student loan debt that resets at a higher interest rate or things like that. There's a lot of things either in the real economy or asset markets with these higher interest rates that could break. And then, eventually, I don't know if it's going to happen in 2016, but I think the Fed's definitely going to have to reverse course at some point in the near future. And then that'll be that moment then. I think there's already a lot of people on Wall Street that are very skeptical of the Fed, whereas they weren't in the past. But any remaining credibility left, when the Fed completely loses credibility, that's when people are going to want portfolio insurance more. And the other thing that we're starting to see, Eric, is, in my opinion, I wrote this in the report, I think the more these general asset markets fall, the more money that's going to go into gold. People are going to say, this volatility, it's giving me a headache. I need more portfolio insurance. I need more cash, and I need more physical precious metal and things like that.
Yeah, and, there's so little money in North American and European markets in the precious metal space. I mean, it's probably about 0.9% of assets under management in total, and I'm talking paper gold for the most part too. We're not the vast majority of that is not somebody hanging out with their Krugerrands buried in their backyard. I mean, so when a very small amount of incremental money that is in bonds and stocks moving towards precious metals, it'll move the market. It'll first move the paper market, because that's where most of these folks think, and they want the ability to have the speed and execution and all of this stuff that they have come to be in culture related with when it comes to looking at paper versus the true portfolio insurance that physical can hold, or mining shares with stock certificates held in your name, or in the very least just outside of street name.
Yeah, Eric, I think a lot of the smarter money, and obviously the more sophisticated investors and traders, they're not going to buy all of their positions at once.
Yeah.
They're going to take months to build up their core positions. But I think we're starting to see a good amount of money rotate from a lot of regular general stocks into gold stocks and silver stocks. So we are starting to see, obviously some of these stocks do drop still from time to time, but these things aren't totally crashing like they were in the past. So maybe they go down a little bit, but then, they catch a pretty strong bid after that. So we are starting to see stronger accumulation now, where I think a lot of the regular Wall Street crowd realizes that, things are getting really bad here globally, and the global central banks are probably going to do something stupid again in the near future with, some other type of money printing program. You mentioned before we started recording, you think it could be, massive infrastructure projects to start building maglev or bullet trains, or, rebuilding roads or bridges or things like that. Or maybe it's like Chris Martenson says, maybe it's a helicopter drop where consumers get maybe consumers get a check in the mail or something. If they pay their taxes, maybe they get $500, and they have to use it. Maybe they have a couple months to spend it, like in Taiwan or other countries have done.
And just to remind people, when President Bush was in his last year, he actually sent out $600 as a refund for tax credits to everyone, and that was a direct mini helicopter drop. And the president's there, and they certainly will pull that out of the bag of tricks that they have. But I think that the whole fiscal, focus is where the big guns are probably going to come next time around. And we saw a lot of discussion about this in the 2008 through 2011 period, and then people will recall when Paul Krugman and other people were talking about the creation of a single platinum coin denominated at $1 trillion, and to fling that into the Treasury, and then to go and have the Federal Reserve print up more debt securities based on that. I mean, the degree to which this fiscal policy means of addressing our problems is something that's relatively fresh compared to the degree to which they've been pumping the wealth effect tool to try to reboot the economy. It hasn't worked, and it only gets people in America more frustrated as well, because they're looking at the political and economic situation and thinking that Wall Street is only getting fatter and fatter while the middle class is evaporating, and that's a largely correct analysis, even though they may not understand all the mechanics as to how we got here.
Yeah, I think unfortunately they're going to blame capitalism, but it's not capitalism that's causing their tax bill to go up or their healthcare bill to go up. It's crony capitalism and politicians and central planners and Marxists and things and fascists and things like that want full government control of the healthcare system. And obviously the government has been, mucking its way in the healthcare system since FDR, when he did wage and price controls. And, then the government started massively intervening in the healthcare system, and it increased with Medicare and Medicaid, and it's only increased massively since then. Go back and watch the speech as President Nixon, I think it was, not President Nixon, Lyndon B. Johnson, when Medicare and Medicaid got passed, he promised that, it would only cost this amount of money, and it's cost way more than that. So, there's just been massive interventions in all these things. And, it was supposed to be stimulative, like you said, for lower gasoline prices. But, any savings the consumer had at that part with lower gas prices, they've had higher insurance premiums, the rent is going up, the food bills. What's happening is the portion sizes are decreasing and the price stays the same, or the quality of the food is down. So there's all these things that the U.S. middle class person in the United States and probably also other countries are under attack. Their bills, the guy on Main Street is not seeing any of this beneficial deflation except for really electronics and maybe the gasoline price. Otherwise, they're not seeing, any of the benefits of deflation, which is an increase in purchasing power. Yeah,
and going back to this theme of ever increasing size of bubbles being blown to rescue the previous crash, that's eroding our economy. It's hollowing it out. We have all this gigantic amount of malinvestment that results from this just completely insane shadow banking system, and it's destroying the middle class. We have seen a 38% decline in the standard of living on a mean basis between 2001 and I think the 2014 was when that study ended, and it's worse now. People are hurting even more, and that's tens of millions of people in the United States that were formerly middle class. There's been a huge shift in the last 15 some odd years, and it's to a very large extent a product of this growth of our financial system becoming this demented monster. It is severely distorting our economy, and it all hooks up into the geopolitical realm as well, too, because, I mean, when it comes to international relations, three principal core pillars of strength come to any given country or empire, and it's economic, military, and moral authority. And the primary means by which the United States is trying to cling to its remaining power at this point is military, but to a very large extent we're defending the economic front because the dollar is under attack, and the financialization of the world economy has created dynamics that other countries are rebelling against, and that's basically the underlying motivation for the rise of what's going on in Asia, with China and Russia working together to counter a unipolar world that has been working against their economic interests. So, I mean, all these things are interconnected, and the moving parts are fascinating to see.
Yeah, well, wealth transfers and redistribution of wealth, these are a cornerstone of communism and Marxism. This is what Marx wanted, and in his Communist Manifesto, he talked about the importance of a central bank. So central banks are really the masters of being able to redistribute wealth. And, most people, it's like what Keynes said, obviously I don't think Keynes was dumb. I think he was evil. I think he was like, a James Bond villain. He was an evil genius and a liar and a hypocrite and things like that. And he had no morals, but he wasn't dumb. So I think he said the quote, about not even 1 in 1 million people can recognize, inflation going on. So that's basically what's been happening is, we've had really for decades now this wealth transfer where, asset price inflation has drastically increased. The housing prices, for decades now, a lot of them have gone up, although, we had the housing bubble. But if you go back and look at housing prices from, the 30s or 40s or 50s up to now, they've, it's almost, except for the large correction in the housing bubble, it's a parabolic function.
Yeah, and, this is a beef of mine I have to interject. A lot of people on the right and in the libertarian community as well tend to look at this whole phenomenon of our central banking system in the context of Marxism and whatnot, and it's actually an incorrect way of looking at it because it is more appropriate to call it fascism, because the interests that benefit from the institution of the Fed, and the Fed is partially, it's a hybrid, it's partially a private institution as well, but, it serves the interests of the banks, and it serves the interests of private corporate interests. It is corporatism, as Mussolini defined it. More appropriately, in broad brush strokes, we're talking about fascism, not Marxism. And I know that's going to piss off a lot of people on the right, and so be it. But, the Chinese have a saying, first, and I'm paraphrasing, I don't remember the exact wording, but, in order to fix a problem, you have to first define it correctly.
Well, the thing is, Marx, kind of like pure Marxism, he was like, oh, we can make our change, our social change and social justice through the barrel of a gun. Yeah. But then he kind of said, you know what, after when that, he was like, well, it would be more so we can do anything we want to accomplish our ends. So any mean would justify the ends.
The thing, and though, I think, what's important, though, is who owns the institution that creates the money. And in Marx's perspective, it was the state that would own it, and the power of the creation of money would be in service of the interests of the state. Whereas now we have, financial system and the creation of currency and our fiat debt-based system that is marshaled and controlled largely by private interests. So, it's just a fact. The fundamental analysis that a lot of people have when it comes to criticizing the United States economy. This is the target to some extent. There's definitely socialism. There's definitely a Marxist philosophy as well for many of the people that are pulling the levers and are in the policy establishment. And even, people like Barack Obama probably have fairly described rather significant leanings as a socialist. But, we live in a mixed economy, and, Obamacare is another great example. The insurance industry largely wrote Obamacare, and it is set up to benefit insurance companies, among other companies. So, that is corporatism. And even though you end up getting subsidies going to the poor, which if they ever come out of poverty, they actually have to pay back. A lot of people don't understand that. But, Obamacare is a great example. What happened with the auto industry is a great example. They're hybrids. They're not pure socialistic programs coming in and expressing in the economy.
Yeah, I was just talking about the philosophy in general, but yeah, they've worked out a partnership where they've gotten the people that are already at the top to maintain the status quo, they've gotten them on board so they can keep having the profits come in and then the regulations come in to protect, competition. Because clearly if we had, innovation and competition, especially in the technology markets, there's a lot of new biotech technologies coming online in the next decade or two that would potentially, help people get a lot healthier, lower costs, things like that. In a free market without, government regulations and things, a lot of these technologies may already be on the market. But, these things are being delayed or completely stopped. Some of them have been delayed for over a decade already. Mm-hmm. So it's just amazing that a lot of people, will blame capitalism for all this when it's not really capitalism at all. But I think, 2016, it's going to be a really crazy year. If you, unfortunately, Eric, the average person, the average investor, the guy who has cash, maybe they're buying a little bit of metal, maybe for their stock exposure, they just buy mutual funds. This year is going to be very difficult for someone like that because the Federal Reserve, in order to protect yourself, they're basically all these central banks, they've created this, with all the extra liquidity, they've created massive amounts of volatility in the system because there's so much money moving around, and asset prices are going to go up a lot, up and down and things like that a lot faster than most people are comfortable dealing with. If you're a financial professional, if you're a options trader, and I wrote about this in my report, if you're an options trader, 2015, 2016, whatever happens with central bank intervention, it's going to be great for you. You're going to make a lot of money. If you're a sophisticated options trader and you know how to, make long straddles or volatility spreads or things like that, to trade volatility. But if you don't know these skills, you're going to have to hold cash, you're going to have to hold metal. A lot of your asset prices are going to fall, and you're not going to understand why or what's really going on. It's going to be very frustrating for most people out there who don't have the financial education and are not very sophisticated.
Yeah, and it's volatility, even right now, when you look at something like VIX, and I'm thinking of products that people can access as a retail investor because there are ETFs and ETNs that can trade VIX. I mean, we're not even seeing the VIX reflect the level of volatility that we had in early August. And then, frankly, when you compare what was going on in August to what's going on now, there's a mismatch. I think we're seeing far greater underlying stress in the system manifesting now, and particularly now that we're already in a so-called interest rate normalization phase where people are expecting the Fed to do more.
Yeah, Eric, I think unfortunately, going forward, because the people in power, they want the status quo, I think we're going to see a lot of the mistakes from the New Deal and a lot of the mistakes that were repeated after the 1929 stock market crash by, Herbert Hoover and FDR. I read a great book by Murray Rothbard about this, and I'm reading one that's similar by Robert Murphy, Austrian School economics professor Robert Murphy, who I had on last week. He wrote The Politically Incorrect Guide to the Great Depression and the New Deal. I think we're going to have, a lot of mistakes made where, there were stupid wage and price controls. We've heard Trump, if he wins the election, he's talking about a tariff on China. We know what happened with tariffs that led up to wars in the past. So let's hope, that politicians don't do this stupid stuff. But I think history, especially in the modern era, the last, 100 years or so, is very clear about the stupidity of politicians and Keynesian economists with, reacting to what happened poorly when the economy is bad and all these stupid measures. Mm-hmm. Okay, well, I want to move on now to the scumbag of the week section because I think, if our listeners want any more in-depth information, they should just go get our report, and maybe we'll do another listener Q&A section. Maybe for Welcome to Dystopia, Eric, after people read the report, they can send in some questions if they have them, and we can answer them. Maybe we can do a separate show on that.
Yeah, that'd be great.
We can do a separate show on that in the next month or so. But I want to get to Scumbag of the Week, talk about some stories. So Hillary Clinton, this is on Against Crony Capitalism's website, which is good for finding articles about scumbags and crony capitalists. Planned Parenthood pledges $20 million last week to help Hillary get elected. Today, Hillary calls for increased funding for Planned Parenthood. Wow, very efficient. It's the payoff system. It's a very efficient payoff system.
Hillary is a very good Pavlovian dog. Anytime money bell rings, she salivates. I mean, there really is no competition here for Scumbag Award of the Year. Come on. I mean, Hillary takes the cake. There's just we had the latest revelation of her email dump that the State Department released over New Year's, and one of the letters in there was her communicating via email. I forget if it was, I guess it was actually the State Department email server, not her private server in New York, but she was talking to Sid, her Sid Blumenthal, if memory serves, her one of her most trusted advisors, and she was asking, well, how do we, deal with this situation in Libya and what's going on there, and how are they going to be able to tell, who's a rebel and who isn't? And then his response was, well, they're primarily just diverting to assessing that on the color of their skin. And, it's yet one more really ugly example of what goes on in the political decision-making process for all of these leaders. She was a sitting Secretary of State and basically was complicit in condoning genocide. An outbreak of war where people are being killed just simply because of the color of their skin. And this is but the latest example of the test of her Teflon. And at some point, I think her Teflon is going to fade. It's already fading vis-a-vis Trump, because in the polling in the last 2 months, her ability to win over, say, 10 polling points back in November has now flipped negative. I mean, Trump is leading her. I don't remember what the exact numbers are, but I think he's somewhere around 5% above her in terms of a theoretical matchup between Trump and Hillary, and the polling reflects that. And I think this is, just slowly but surely people realizing how much of a true scumbag she is. And I don't say that because I love Republicans. I mean, I'm a member of the Republican Party, and I joined it a couple years back simply because I wanted to reform it. I'm more of a libertarian in my perspective and whatnot. So, I mean, I'm not making a partisan statement, and anyone who reads my work knows that I take many a pot shot at plenty of Republicans.
Yeah, I mean, Hillary also got a crony capitalist deal for one of her buddies who had car dealerships in China. And, we see the news stories with the FBI probe expanding into more of her political, the donations she got and things like that. But, I know some lawyers at the Department of Justice, and a lot of them are hardcore progressive women lawyers who love Hillary. So, I mean, the people who would be in charge of charging her, right, the Department of Justice, because the FBI would bring its findings to the DOJ, right, and they would be the ones in charge of deciding whether or not to charge her. Those guys, a lot of them are all hardcore Democrat progressives, and a lot of them are, very strong female woman types who have grown up, with feminism and Hillary Clinton and things like that. So it'll be interesting to see if they flip on her. I don't think they will flip on her, but we'll see. She is losing in the polls, though. Well, she is falling in the polls, like you brought up, but, there's always clever tricks to get her back and things like that.
And, in our quasi-two-party system, if she ends up being the front runner, then they will have a new challenge of just resuscitating her reputation, because she'll just be the front runner, and that'll be it. And, that's part of how our oligarchy survives, by this theater of rotating between the lessers of evil. People get pissed off at Bush and his aggressive foreign policy. They elect Obama, and Obama ends up being just as bad as Bush, and the economy is rolling over. Now people are going to be probably looking towards Trump ultimately and saying that he's going to save everything, and that remains to be seen, But we recall when we were talking about Hillary, I guess it was back in April, where I came to the conclusion that this ongoing process of her accumulating scandal after scandal revelation as baggage would ultimately take a toll on her. And I think my forecast is correct. It's just we didn't have enough time. And if there were another 6 months, she'd be a goner. But the thing is that the Democratic Party, the power structure that reaches out and cultivates candidates and tries to figure out who would be the best person to put forward in terms of their strategy and all of that stuff. The machinations of the party politics made a mistake. They decided to run with Hillary because basically she is the heir apparent, and they put a lot of their political capital in her camp early on, and then got themselves stuck. And this whole question and flirtation with Elizabeth Warren that we were seeing earlier in 2015. It's interesting that Elizabeth Warren voted no against the audit of the Fed bill. I mean, of all people, she's been marketing herself as, someone in the progressive camp who would be willing to go up against the forces of Wall Street. And then all of a sudden she is now falling in line with the propaganda line that people like Harry Reid and the Democratic policy establishment have been putting out, saying that, well, you can't audit the Fed because that would give the interests in the banking community and by extension, those evil Republicans who have closer ties than us Democrats, more power over the banking system and such that, they're going to basically elevate Wall Street interests. And this is coming from Harry Reid, who only a couple of years ago was in favor of auditing the Fed with arguments exactly to the contrary, that the Fed has too much power and that we have to rein it in and on and on. So, we've seen these little signals and the shifts of the strategies that these politician creatures do for public consumption, the way they position themselves with their constituents and whatnot. And I think that there's insight to be had there from this vote that Elizabeth Warren did. She's falling in line with that whole Democratic agenda when it comes to the Fed, and who knows, maybe if Hillary does go down in flames in the next 3 months because of one bombshell too many, maybe we might still see Elizabeth Warren or somebody else come in, because they certainly wouldn't want to be back in Bernie Sanders. That would scare the crap out of the oligarchy, an outright socialist. I mean, Bernie Sanders is there in part for this political feeder process, in my estimation and analysis, because, it's an escape valve. It lets some of the frustrations of the public out when it comes to their, realization of the economy is under strain, and like we just described, with a 38% reduction in the middle class's standard of living. People are hurting and they want change. So we get these, more like theatrical elections. It's kabuki theater.
Yeah, I think there's a lot of book smart people who do love Bernie Sanders. They have a lot of degrees from the university, and they're like, oh, I hate capitalism, and oh, Sanders makes so much sense. Mm-hmm. A lot of them don't have any common sense, though, so they don't understand the economy or the Federal Reserve or what's really happening. But I don't think there's any way the corporations would want Bernie Sanders, because, he would force them to move even more money offshore. He would come up with new tax schemes and other things like that. He would maybe force their costs higher. Then they may not be able to wiggle out of some of the cost structure with his taxes and things like that. And the people who do support Bernie Sanders, and there's, a very large populist movement. There's a lot of people who just graduated from college who love Bernie Sanders. Yeah. Even more, I think, than, Ron Paul or Rand Paul, which is not how it should be, but that's, Bernie Sanders is more mainstream than Ron Paul or Rand Paul, because, he fits in there with, it's all the evil capitalist fault. But, it's just really sad that the country, there's not a lot of people that, there's, I guess, 20 million, but compared to the whole size of the United States, I mean, Rand Paul and Ron Paul are looked at as kooks, and Bernie Sanders like, oh, Bernie has so many good ideas and things like that.
Yeah, and the progressives, in the progressive wing, generally speaking, in the Democratic Party, are essentially used, like I was saying, as a foil. It's an escape valve mechanism. Basically, people have the ability to criticize the system, and in the reality, the core of the Democrats reflect the basic politics and orientation of someone like Hillary Clinton. And the Democratic Party is pretty much just as much crony capitalist supporting as the Republicans.
Oh, these guys act like, they're champions of the poor, these Democrats, but a lot of them are hardcore, limousine liberals. They're enormous hypocrites. A lot of these guys are really rich Democrats. They made money, with their political connections or trading on inside information, like Nancy Pelosi getting a preferential Visa IPO and making like $5 million in only like a month or two off stock trading. And, Harry Reid doing all these with inside information from his congressional position, doing all these insider trades on real estate deals and making, many millions of dollars. These guys are all scumbags.
I'd like to joke.
Both sides of
a lot of people are really afraid that Obama, because he's so crazy and loves power, that he would, try to do something to deal with the constitutional restriction on serving a third term. But I joke and say, no. He wants to follow Bill Clinton's path and make billions.
Yeah, he wants his presidential library, and he wants to go on even more vacations.
if you can even imagine golfing more than he already does.
Well, I'm sure he'll find someone else to pay for it, right? So, because he's doing that now, he's going on vacation on the taxpayer's dime like crazy. But my last scumbag of the week nominee, you already touched on it a little bit. It was actually all the Congress people that didn't vote for auditing the Fed. There was a decent amount of them that said they would, and then I guess they flip-flop for whatever reason. You name one of them. But, clearly the Federal Reserve has created massive amounts of problem for basically since its inception, although it wasn't nearly doing as much damage to the economy when it first started. But, it's just gone exponential.
It's the shadow banking system. It basically, since we went off the gold standard, and then further layers of deregulation over the preceding 2 decades, we've had the shadow banking system absolutely go bonkers and explode in size. And as it has grown, it's created capital distortions, malinvestments, and literally moved 20, 30, some odd % of the U.S. economy, shifting it into bad investments. It's that pervasive. And then we get these crashes. We get bubbles and crashes at a magnitude that, we see on a regular basis a cyclicality that's more frequent than we saw in, say, World War II years, post-World War II through the 1960s. The degree to which we have these devastating financial market-driven crashes that spill over into the real economy and screw things up is happening far more frequent and at a magnitude that is reflecting this beast in the shadow banking system that's gone completely bonkers.
Yep, big government, central banking, and all the other problems it's created. But, it was really funny. I didn't watch the Obama State of the Union address, but I did see a clip of him, talking about how great the car sales were. And, I was just laughing thinking about, all these car companies giving, no interest, no money down loans for many, many years to people with bad credit. And he's talking about how good that is. But, the Austrian school economist in me is thinking about the unintended consequences, the long-term consequences of this credit bubble.
Yeah.
So, there's so many examples of that. But, here it is, he's obviously been, I guess, lectured maybe by Paul Krugman or Janet Yellen or some of these other Keynesians on some of the basics of Keynesian economics, that, as long as we get people to spend money, it's good. Consumerism is good. Taking on credit you can't afford to pay back is good. And it's going to be tears in the future because, look at all the debt that's been taken out all over the globe in different asset markets and in different real economies and emerging markets. A lot of this debt can't mathematically be paid back anymore. So there's going to be hell to pay at some point in time in the future.
Yeah. Financial repression and all the other tricks that they've used for problems in the past will not address the problems today. The problems are too big. So
I agree. I agree. But they're trying to solve a debt problem with more debt, trying to put more credit out into the system. And, they're trying to prop the asset prices up. They were successful at that for a number of years after the 2008 crash. But, we're seeing now that 2016 may be the year that things start to completely come apart, 2008 style or worse. It's tough to say what's going to happen. But, people, we wrote about this in our report. It goes back to the 3 rules, Eric, that we have. And, the politicians are going to change the rules. I live right outside of D.C. It's all lawyers here. There's one of the largest per capita amount of lawyers living here of anywhere in the world. I think this and New York City are 1 and 2. And, the rules are going to change. So if you think, you have this amazing investment or trade going on and then the politicians change the rules on you, so it's going to be very frustrating for most people. And you should blame it on the politicians and the government and Wall Street and things like that, and crony capitalists and special interest groups. But unfortunately, I think a lot of people who aren't as educated as people that listen to the podcast, they're going to blame capitalism and corporations, every single corporation, even small business. They're going to blame all these guys who are just trying to survive the disaster that's unfolding right now.
Yeah, and it should be said as well too that we certainly have excesses in capitalism, and it isn't just the problem of crony capitalism and all of that. I mean, the credit system, because of its distortions, ends up facilitating the fertile ground upon which just dumb things happen. So, capitalism deserves to be criticized. It has problems, but I mean, it is the best system that has been able to provision the largest increase in the standard of living for the most amount of people. And what needs to happen is that, and this is a really big subject for an entire podcast in and of itself, but what needs to happen is that we just need an enlightened form of government that basically creates the conditions by which, real capitalism can provision greater standard of living for more people and better efficiencies and less regulations, but at the same time, make sure that you do have some kind of a social safety net or maybe tax incentives for private industries and private individuals to help further grow a private social safety network in addition to whatever government does. That's what was going on in the 1800s, the late 1800s. There are different models by which you can provision some kind of a society that does take care of people who are struggling or might need a little bit of a hand up rather than, some kind of a welfare system that creates incentives that end up creating a lot of economic activity as people make decisions to not be productive because simply that's the incentives they get. And there is that problem in our system.
Yeah, so we nominate all the Congress people who voted no for auditing the Fed. They're scumbags of the week. Yeah. You guys can look up all the different.
Harry Reid definitely, at the top of that list too. I mean, his flip-flop is pretty sickening and emblematic of what really goes on in our system and how these politicians are just basically puppets and actors.
Yeah, a lot of these guys have no morals, and as Doug Casey says, the political system attracts, sociopaths, people who care about power and are willing to make deals or do anything to get more power and things like that. They don't care about money as much; they care about more power because they know if they have the power, the money will easily come after that.
As a tangent to I can't resist. I mean, that actually isn't just a statement of opinion. It's a clinical psychological fact that's been backed up by a lot of research that roughly about 1% of the population in North America genetically are sociopaths or psychopaths. And they tend to do pretty well in business. They tend to be above average in intelligence. And because the psychology is such that when you don't have a moral compass, you're willing to do things in business that basically step on people. Or in politics, probably even more so in politics. You end up getting this kind of, concentration of people that you wouldn't want to necessarily have over as your friend for dinner or have a beer with.
Yeah, so I think, Eric, it'll be a minor miracle then if central planners and the Federal Reserve are able to actually keep the markets from fully crashing, 20% or more maybe, type of crash than before the next presidential election in November 2016. So we have a lot of crazy things going on in the world. The oil price keeps going lower and so many other crazy things. And 2016 is going to be a very volatile and crazy year. If you own a lot of regular stocks, dividend stocks and things like that, you should look into buying insurance on those. You should start reading and learning how to do that because it could be one of those crazy years where it's like 2008, where you just lose an enormous amount of value very quickly. I could see that playing out depending upon, if the central bankers want to come back in and try to prop up asset prices. Who knows if it'll work, though, if things are, spiraling out of control. But for listeners who have any questions about 2015 review or talk about 2016, type your comments underneath this video for another future show, and Eric and I will try to answer as many of them as we can in one show. And if you haven't read the report yet for Wall Street from Main Street that Mo Dawood and I did, again, go to the wallstreetfrommainstreet.com website. That's WALLSTFORMAINST.com. And right on the front there, there's a post about the report that you can click on and click through and sign up on, or there's a sign up page on our email list on the right side of the website. You can sign up, and then you should be able to get the report. It's free. It's pretty comprehensive. I think Eric's read it by now. And I think we cover a lot of markets there. It's not just all, investing, trading ideas. We cover a good amount of the markets, and there's a lot of interesting questions for 2016 that are going to be challenging. I think 2016 is going to be a volatile, challenging year. It's going to be good for those options traders who make money long or short. I don't think we're going to see really many markets, Eric, stay sideways or flat. I don't think this is going to be one of those years where everything's calm. I think, Doug Casey used the analogy about going through the eye of the hurricane. I think, inside the eye of the hurricane, things are calm. I think we're through the eye now.
Yeah, very much so. And as a final comment, I want to make to people who are not necessarily among our audience who are traders or heavy investors or what have you, but if you're just looking at your own financial position and looking at all this volatility and uncertainty and the dangers that are ahead in 2016, one of the most basic things that you can do, and I recognize that it's going to be hard to do for a lot of people, but where and when possible, reduce the amount of debt exposure that you have. Because when we go through periods of asset deflation spilling over into real economy deflation, and that's what we're having, debt really is dangerous. It can put you in a position where you have to, service a debt, and maybe you might lose a job or whatever situation creating such that you don't have the ability to make payments very easily. It's one thing to say, I want to get exposure to precious metals or try to do some kind of investment that would benefit from any given move that you anticipate going forward. But one of the easiest things to do to increase the level of security you have from a financial position is really just basically reducing debt. And, when we were moving in the 2010, 2011 period, it looked like an inflationary spiral in connection to a Federal Reserve going and other central banks going berserk would probably have really high odds of spilling over into the real economy. And it didn't happen. And we had a lot of monies and currencies and credit sequestered within the central bank's balance sheets. And the real economy didn't have an inflationary spiral across the board. It only manifested in financial assets and in particular sectors of the economy. So it gave people a lot of head fakes when it came to trying to figure out, well, are we going to have a deflationary crash or an inflationary boom kind of thing, crack-up boom. Going forward, the risk of holding excessive debt that you can't service is really, really high. So that's something that people should give a lot of consideration to and figure out the best way that they can reduce debt if at all possible.
Yeah, and I talked about this in our report, with inflation and deflation. I put a good analogy in there about earthquakes on the coastline and then tsunamis that follow it. People shouldn't bet on just trying to survive one. They should want to survive both.
Yeah.
So, betting that only one thing will happen and only one thing will affect you is unwise. So if you, gamble that, hyperinflation is going to occur guaranteed, well, if the earthquake kills you, it doesn't matter then if you designed your portfolio and your life to survive the tsunami.
Yeah.
So, thank you for listening to today's episode. This is episode number 14. Eric and I plan to continue cranking them out in 2016, my health permitting. I've been battling some serious health problems, unfortunately, in 2015. For my close friends who are aware, I had I was diagnosed with fatty liver disease, and I probably have some other health problems. I have to go see specialists and stuff. I didn't have any energy. So 2015 was a rough year for me health-wise and a lot of other reasons. I am hopefully, now that, I'm back on a paleo diet, I am going to feel a little better, and hopefully I'll be able to do more interviews, start cranking them out faster again. But, I was really around October, around my birthday of last year, I basically hit a wall, and some days I could barely even get out of bed. I was that sick. I had short-term memory loss, completely migraines, just really bad health problems, and I had to get a bunch of I had to get like blood tests done and all this other stuff.
Yeah, and I was feeling so sorry for you that I recruited a tick to bite me, and then around the same time I was going through Lyme symptoms that were horrible. So between the two of us, we really didn't do as many shows as we would have liked to have. So we apologize for that, but I'm feeling a lot better now. I'm kind of like in what they call chronic condition of Lyme, where it's probably something I'm going to be able to eradicate in full. And it's been about 6 months, and I no longer have brain fog, and I'm still, suffering from minor things here and there. But Lyme disease is interesting. I mean, it's the fastest expanding disease in America right now, and it's going to be something that a lot more people are going to be aware of it in the years ahead. If you ever get anyone out here, if you ever get a tick bite or even any kind of bite, actually, because sand fleas and mosquitoes and so forth actually transmit Lyme as well too. But if you ever feel anything like a fever or stiffness in the neck or pain in knees or anything that just seems a little weird in relation to some bite that you may have experienced, assume it's Lyme and start investigating immediately, because time is really one's asset when it comes to fighting Lyme.
Well, Eric and I just want to wish our listeners out there health, wealth, and happiness in health before wealth, because, if you have all the money in the world and you're sick and you're dying, it doesn't really mean a whole bunch. Yeah. So thank you for listening to this podcast, and, for the future show, for us answering listener questions about either the report or about like review of 2015, preview of 2016, just type your question beneath this episode. Thank you again for your time listening.